Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today we are talking about claiming your $10,000 tax refund. Catchy title.
Thanks, Michael. And probably would have been more catchy if you didn't just have to repeat it 6 times while we did sound checks and all the rest of it. I actually thought it's a bit gimmicky, this title, but it's is it still gimmicky if it's true?
Yeah, look, I imagine this would prick up the ears of most people because people love to get tax money back.
Yep.
Look, what's even better is when we go through the example. There's 2 types of tax refunds. There's ones where you throw money away.
Yes, yeah, that's
to get part of it back.
Yeah.
Which are bad.
Yeah.
And there's other ones where you put money away and that grows and you get to use it later on and you still pick up tax refunds.
In a better position.
So we're talking about the second version here, the best type of tax refund.
That's exactly right. And I think for most people, most of our people who are coming in to meet with us are wage and salary earners, and they kind of know of or hear about people in business who can, adjust things and claim all sorts of things on tax. And they go, every year they go, this is crap. I go in to see my accountant.
Yeah.
He's got my group certificate. There's not, I claim a little bit every year, but there's just no way out. And so this is a really good one because you don't have to be a small business owner. You don't have to have any sort of complicated structure. It's very simple. Not much work involved in making this happen. And it's like you say, the beauty of it is it's not a tax deduction or a tax refund that you've had to throw away, $30,000 to get $10,000 back. You get to see the benefit of that in the future. So what we're talking about here is making before tax contributions to super. So as we said before, for most people, making contributions to super has either been something that their employer has done on their behalf for most of their life, or in some cases they have done a bit as well as a salary sacrifice payment via their payroll. So most people are kind of aware of those types of contributions, which is your salary sacrifice, the top bit of your income. Your employer, instead of paying it to you, puts it straight into your super fund, and you don't pay income tax on that.
Yep.
So as of the last couple of years, even wage and salary earners have been able to do this via a different strategy, which is that they can make a personal contributions to super. So they can actually take money out of their bank account, put it into their super fund, and then they can lodge a form to claim that as a tax deduction.
Yep.
So
an example there, if you put $10,000 in out of your bank account, and you're on a 39% tax rate, you would claim a tax deduction of 39%. You would get back an extra tax return or refund of $3,900.
Yep. It's not quite free in that there's a contributions tax on that money going into super.
Yes.
So it's not, you don't get to keep the whole amount. But what you're sort of referring to before there is that if you look at that $10,000 example, you put $10,000 into super, instead of you getting taxed at $3,900 on that, you go, when you do your tax, you get an extra refund of $3,900 in your kick, which people love. The $10,000 that goes into your super, you get taxed at 15% on that. So you've still got $8,500 there that's in your super fund, and that's a part of what we look at with our clients as well, is working that money as hard as possible. So if you've got 10 years to go in your working life, you can see that if you do something like this every year, you get to keep more of your income and you get that growing behind the scenes.
That's right, and that's where we net out the difference, don't we? We say 39% as a tax deduction, 15% less 15% tax paid.
Yeah.
Hey, that's 24%. So what I've really got is a free money percentage of 24%. So for the $10,000 that I've put in, I've got a net benefit of $2,400 of free money. Now, we say that's a 24% overnight return, and look, there is just no investment anywhere worldwide that you can get virtually a 24%
that's right.
rate of return overnight. So it's one of those things that we want to pick up for all of our clients and maximise.
And that's a part of it. The other part of that, I guess, is that we know that that's a net difference of 24%. But if you look at, and we just recorded a podcast about this, about making personal contributions to super instead of salary sacrificing, because what you actually experience on the receiving end of that is you don't see the 15% tax come out. All that happens is any dollar that you can put into super, if your marginal tax rate is 39%, any dollar that you can afford to give up, when you go and get your tax done, you'll get a refund of 39 cents for that dollar.
That's right.
It's a big amount. So there are some limitations. There are some limitations on that, in that there's a $25,000 concessional contributions cap, so, which is a great bit of alliteration. But what it means is $25,000 is the limit of contributions that can go in from your employer's contributions and contributions that you claim a tax deduction for. So there's a couple of different parts to this where we'll eventually get to the gimmicky $10,000 tax refund. But so that rule has been in place. Most people are kind of aware of that $25,000 threshold or that limit. The other one that's really handy that's changed in the last couple of years at a similar time as the ability to make personal contributions is that you can now actually make catch-up concessional contributions, which they've always got great concessional contribution caps and catch-up concessional contributions.
Would you believe they've changed the name from catch-up to carry forward?
Carry forward. Yeah.
So this is another bugbear with our industry. It's so confusing that they first of all called this thing catch-up contributions,
and now they've called it.
And now they've just changed the name officially to carry forward contributions. So if you're googling it, type in carry forward contributions, not catch up.
They really couldn't make it sound more complicated if they tried. So you use carry forward. You use carry forward concessional contributions to use up your concessional contribution cap, which used to be called catch up concessional contributions. But the point with this is that from 1st July 2018, if you don't use up your $25,000 limit for that year, you can use it. You've got up to 5 years to use that, as long as your super balance is below $500,000. So I've just worked out a couple of quick examples here to see what you could do in this financial year. So leading up to the end of the financial year, everyone kind of thinks about, is there anything I could do to minimise my tax? And there's normally nothing sort of concrete other than spend money on things that you probably don't need.
Yes.
This is a fantastic one. So if you earn $120,000 a year, so I'll do two examples here. If you earn $120,000 a year and your employer's paying 9.5%, which is the standard rate of super contributions for you, that's about $11,400 per year.
Yep.
Now, if you've been on the same income for last year as well, so for last year you got $11,400. For this year you get $11,400. For the 2 years you've got total super contributions from your employer of about $23,000.
Yep.
Now, as we said, you can make a personal contribution. You can use up the cap for $25,000 for last year, $25,000 for this year. You've already received $23,000. You've still got $27,000 that you can.
So in easy to understand terms, you add the two terms $25,000 over the 2 financial years.
Yep.
Which is the 2018-19 financial year and 2019-20 financial years. That gives you $50,000. Your employer has made a total of $23,000.
Yep.
So you have a space, remaining space of $27,000 that you can put in there.
Yeah. Now, this is the other constraint, I guess, with this strategy is that you've got to have the cash sitting there.
You've got to have the cash. However, look, a lot of people listening sit on reasonably sized piles of cash.
Yep.
Look, it's a common thing that we see. So if you do have the cash, it's a great one to utilise. And
it's a good one, I guess, from a cash flow perspective of leading up to the end of the financial year. You could say for this person in June, they could make a $27,000 contribution into super. So if they've got a bit of cash tucked away, they could put $27,000 into their superannuation account. They lodge a form to claim that as a tax deduction. They turn around in July and go and get their tax done. They would get an extra tax refund of $10,530.
Yep.
just based on that contribution.
Yeah. So the real cost. I mean, let's say that the true cost is $16,500. So they put $27,000 in. They get $10,500 back. As a tax return, extra tax return. Let's call that it's cost them $16,500, but right. they've got that money into the superannuation and working for them.
Exactly right. So it's a really handy one from that perspective. If you've got a bit of cash, which most people in your 50s have sort of got your debts paid down to a reasonable level and they're building up a bit of cash, and it's just a matter of what's the we often have this where people come in and ask us, I've got a bit of cash tucked away, what's the best use of that? And as you said before, an immediate tax saving is the best investment return you can get.
Yes.
Because it's guaranteed. It's not we hope that this will happen or we hope this will happen. If you put that money in, you lodge that form, you claim that deduction, you will get $10,500 back as a tax refund.
Yeah, that's right.
So the same thing applies if you're actually on a lower income. Your marginal tax rate is slightly lower, but you can actually get more in. So the good thing about this strategy is that whether you're on a higher or lower income, you can get a similar sort of benefit, really.
Yeah.
So if you're on $80,000 per year as your salary, again, your employer's paying 9.5%. That's $7,600 each year. So if we round that to 7.5, again, over those 2 financial years, that's about $15,000 for the 2 financial years that your employer's put in. As you said before, you've got a $25,000 cap for last year, $25,000 cap for this year, $50,000 in total. So you've got an extra $35,000 there remaining that you can put into super. So that's kind of what I was saying. In the previous example, you can only put in $27,000. In this example, you can actually put in $35,000. Now, your marginal tax rate, if you're only on $80,000 a year compared to $120,000, at $80,000, your marginal tax rate is 34.5%. Slightly lower, but you can get more in. So in this case, you put your $35,000 into super, you actually get a $12,000 tax refund.
Which is $35,000 multiplied by the marginal tax rate of 34.5%.
Exactly.
So you get $12,000 in tax refund. How you do that as a couple as well, there's $24,000. So look, it's
we did debate whether to call this claiming your $20,000 tax refund. We thought it sounded a bit unrealistic. So, but this is, I guess, the thing that as you said before, these things are not. It's not rocket science. It's just a matter of this is what we do day in, day out.
Look. I think one of the most, if not the most valuable thing you can do for your retirement planning is to take advantage of maximising your $25,000 concessional contribution caps every year. Because it's just so valuable. There's a 24% overnight return. Hey, you've actually to get that tax deduction, you've actually had to put the money into your superannuation fund. By its very nature, then it's working for you.
That's right.
After that, so what's really good about this is that if you turned, let's just say 55 on the 1st of July, 2018. You've actually and you haven't taken advantage of that $25,000. For last year. You're really 9 years. You've got only 9 years left before age 65 now, or a little bit less. So what this allows you to do is to turn back the clock or wind back the clock, so to speak, and say, okay, we can take advantage now of what we didn't use up in 2018-19. We can take advantage of that in 2019-20. Which, and beyond that as well, I guess what we're really looking at here in these examples is actually taking advantage of that before the 30th of June 2020. Because that would be in this financial year. Hey, if you look at if you did miss that cutoff, you're listening to this after that point in time. You can still use that. You can do that next year, and you can do it the year after. So you can go back 5 years. It becomes a bit tricky if your income's lower. Practically there's probably only really 2 or 3 years that you can catch up on, because once you've deducted so much from your income, you're actually not paying that much income tax. That's right.
But what I really like about this one is you would have this all the time. Every time someone comes in to see us, they kind of go, I wish I came and saw you a couple of years ago, or I wish I came and saw you 5 years ago, or I wish I came and saw you last year, or whatever it is.
Yeah, that's right.
The thing I really like about this strategy is that, well, yes, we can't go back in time, but we can take advantage of that tax saving from last year.
Absolutely, yeah. No, it's a good one because that is what everyone says, regardless of when they do come in.
Yeah. And
now we can say, well, we can actually turn back time here to an extent.
And that's I guess the other thing I say. We use these big round numbers just because it's easy to sort of show as an example. But I've got new clients that just came in recently who I said, hey, good news, they're on about $80,000. I said, hey, good news, we can put 35 grand in the super, we can claim this and get $12,000 back. That sounds great, but we don't have the $35,000. Yeah. So the point I'd make as well is that the strategy still works even if you don't. Whether it's 5,000, 10,000, 35,000.
Yes.
The percentage returns, the percentage tax refund is the same. It's just you can do what you can do. If you don't have $35,000, you might have some money that you can do.
Yeah, I mean, there's variations of this strategy, isn't there, as well? Like, so you can say, okay, well, you don't have that. Okay, instead of we could take advantage of going forward $35,000 a year for a number of years to use up.
That's right.
What you have available. Yeah. So there are quite a few variations. You could, I mean, if you had $0 cash now, we could formulate a strategy and would formulate a strategy to take advantage of that. Just by tweaking what your future earnings were going to be.
And that's a good point because I think that's kind of where the earlier the better with that, because like you said, if you don't have the cash in there but you do have a bit of spare cash flow, and when we have a look at that with all of our clients, is that if you don't have a huge amount spare every fortnight, the sooner you get started on that, the sooner you're actually using up those years before you run to the end of that 5-year time limit. So it's it's made it. I actually think it's been a really good rule for most, this change to the ability to carry it forward or catch it up or whatever the government wants to call it. You're at least allowing people to take advantage of all these things, not based on an arbitrary figure of you didn't have the cash in this year, therefore you miss out on that.
That's right. Yeah. Look, and it's always been disappointing in the past because if someone's missed out and they've paid that extra tax, that money's gone for good, or it was gone for good. Yeah. So once you did your tax, or not even once you did your tax return, once the 30th of June came around, if you didn't take advantage of what you could have taken advantage of, that money, that extra tax that you paid, was gone to the ATO for good. There was no getting that back. Now, to an extent, we can say, okay, well, what happened in 2018-19? We can the unused money, or what was previously a waste, it was gone to the ATO. We can actually now bring that into 2019-20 and take advantage of it, which people love because I mean, and this is the first financial year, the 2019-20 year is the first financial year that this strategy has become available.
I feel like we're very excited about this, and
I'm so excited.
It's like the sort of thing most people would go.
Well, number one, free money is what we love here, because a 24% rate of return overnight. The difference, in the 39% tax example, 39% tax deduction less 15% tax paid on the way into super. There's a 24% net benefit. Hey, that's free money. That's an overnight return. Love that. Number two is, look, it's a victimless crime. Look, I love my friends at the ATO, and if anyone's from the ATO is listening, this is what's even better about this is purely legitimate strategy.
You guys made the rules.
So they made the rules.
We just followed.
So it's free money, and it's a victimless crime because we're taking it from the ATO. So look, it's just great.
And I think there's something about these big lump sums as well for most people when they come to see us at 55 and you go, hey, you've got a bit of cash, hey, we can do this and get a $10,000 or $20,000 or $25,000 tax refunded this year. You can just see them going, yes, finally. I've been paying tax for 35 years. This is my time to call some back. So it's great.
So, I guess anything else that you'd like to add, Dallas, in wrapping up, or the important thing to do to take advantage of this is to look at it well and truly. Before the 30th of June. So
that's I guess
you need to actually do the calculations. And work that out to logistically get the money in and cleared before the 30th of June, which is the cutoff date. Look, if you're listening and you're not a client of ours, we'd be only too happy to meet with you to discuss what we do for our clients. You can reach us at lighthouseadvisors with an .com.au, and we'd be only too happy to meet with you after that. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.